Hey everybody, this is Mike Finnen from Buttonwood Tutor. I am back for another take on part two of the Series 63, which is a state-based NASAA exam. Um, and as I've said before, the Series 63, it used to be a layup. It used to literally be a victory lap, but it's definitely gotten more difficult and we get more students over the year. And also the six Series 63 covers most of the USA regulatory information that you'll need for the 65 and the 66. So you'll see as we build up playlists of the 65 and the 66 that there's going to be some carryover with that. So first slide I have up here is about investors. And what is that coming down to? So we're going to talk about persons, right? What are persons? And again, persons that you think of walking down the street is different than persons on this. What is a person? Any individual or organization, any entity that can enter into a binding contract. So let's go who's not a person. And this is using my brother's saying, dead, dumb, don't touch, right? Dead is a dead person. They're not a person. But dead can also be a piece of paper, right? A stock certificate or a balance sheet or an income statement, not a person. That's a piece of paper. But the entity that is covered by could be, right? So how can a company be entering a binding contract? Well, there's representatives, right? So the CEO, CFO can sign a contract. With the school, they can sign into a contract. The principal or the supervisor can sign the contract, or custodian, the head custodian can sign a contract. If you're in New York, the custodians are very powerful people in New York City as far as schools go. Um, in so dead, dumb, don't touch. Dead, piece of paper, dead body. Incapacitated, dumb. It's not politically correct, but it is what it is. That's somebody who got hurt, who can't take somebody who, for whatever reason, has lost the capacity to take care of their own affairs. And obviously, minors 18 and under don't touch. Also, investors, institutional investors are pools of capital in general on this test and all tests. Institutions are supposed to take care of themselves. They're supposed to have enough infrastructure and enough institutional knowledge and employees to protect themselves from anything that might be unscrupulous. So, in general, when you're dealing with institutions, you get the exemption that you don't have to register. Again, as always, unless you have an office in the state, right? If you no office, no retail, no register. Anything else, you go. All right. So retail, and who are retail? And on Series 63, there is a distinction between retail and accredited investors, right? Because the state administrator, which is the SEC of the states, don't recognize accredited. They only recognize qualified, which is another kind, but they recognize retail investors. So who's a retail investor? If Elon Musk walked into your office and he was not represented by he was not representing one of his companies or by an institution, he is a retail customer. And everybody below that, right? So everybody who's not a company is considered a retail. If you're there for personal or family goals, that is a retail customer. And de minimis, we talked about already, again, only for investment advisors, only for IARs, no state registration, five retail clients in the state or less, and you can use that de minimis rule, which is an exception. Okay, now let's just take a quick look. State administrator. So what state administrator sounds like one person in a state in a little lonely office, but that's not usually who it is. Like in California, it's a huge office. In New York, it's a huge office. This is the SEC of the states. Okay. This is they handle registration regulation of persons and securities within the state, and they enforce the security laws. They enforce the USA laws. Don't forget, they enforce the USA, and usually it's through NASAA. Um, what is their main goal? To stop fraud on the retail level, to protect retail investors from fraud. That is the one time, as far as the administrator goes, all gloves come off anytime there's fraud. They can investigate anything they want from that person. So they handle the registration and registration and regulation of persons within the state for their U4, their U5, ADV, ADV 1, 2, whatever they're registering within the state that they have jurisdiction over. But again, SEC trumps state administrator. Okay, that changed around the mid '90s with NSMIA, where they said, okay, they were kind of having battles with each other, and now they said, look, if it comes down to an SEC rule or a state administrator rule, USA Act rule, SEC wins. So the state administrator can enforce the security laws and anti-fraud provisions within their state. Um, and generally speaking, the way we think of it is so let's talk about two things: jurisdiction, registration. Jurisdiction and registration are two different animals. Um, when does a state administrator have jurisdiction? Anytime an offer or a sale is completed in their state, anytime something originated, directed, or is accepted, um, gives them jurisdiction in the state. So if it's an offer or a sale happened in the state, that gives them jurisdiction. They can deny, they can suspend, or they could revoke the registration as a punitive action. So if somebody's applying for U4, they don't like it, they could just deny it. If they have a registration, then they can suspend or revoke. And what's the difference? Suspend means you got taken away, but you can probably get it back. Revoked means you're out. That's it. And punitive action means they're taking something away from you. As far as record retention, for those of you who've taken the 7 or the 6 or the SIE, you remember there's a 3-year, 4-year, 5-year, 6-year lifetime. Different with the state. Okay, state's easier. IA are 5 years. You got to keep record. BDs are 3 years, and you have to keep the last 2 readily available at all times. So IAs are 5 years. BDs are 3 years, readily available for the past 2 years. Okay, this next slide covers registration methods, and this you have to know. This is non-negotiable for this test. This is the ways that you register or tell the state that you're going to be doing business in the state. Okay, so the first one is notice filing. If a company or security is a federally covered security or investment advisor, then they just have to let the state know they're there, saying there's no office in the state. They don't have an office in the state. They just have to say, look, we're already SEC registered. We're letting you know that we're there. They're going to pay a fee, and that's that. The only time the state admin has any jurisdiction or any ability to investigate that a company that's federally covered or to tell them what to do is if there was fraud in the state. That does change it. And I started talking about something earlier. I want to get back to it. There's two different things. You have registration and then you have jurisdiction. Jurisdiction is any time that something happens in a state, it's a sale or it's an offer or a sale in the state or accepted, directed, and in the state, they have jurisdiction. But registration's different. So notice filing, that's not registering, they're just letting them know that they're there. Okay. There's times that you don't have to register, right? Municipals, any government securities are exempt. They never have to register. As we said earlier, the vacational, the institutional. But just because there's no registration doesn't mean there's no jurisdiction. There's jurisdiction comes with the actions. All right, coordination, which I find to be the most complicated one. Coordination is and it's only securities. You want to do business in multiple states, but you're not big enough to be a federally covered security. So what you have to do is you have to go and register at the SEC and at the state level. But SEC's daddy, right? Remember this. SEC determines when it's effective or not. And remember when I said they're effective. I didn't say they approved it, they didn't pass on it, they didn't guarantee it. They approve it, they're just saying it's effective. SEC SAS is the one who determines whether coordinated securities are effective or not. And the state registration forms have to be in 10 days before the SEC deems it effective. These are used for interstate securities that are not already federally covered. They balance state and federal requirements. Next, qualification. Qualification or state registration only, intrastate. So think of it like, remember in high school, college, intramurals were when you played other people in your school or your area. Intercollegiate, inter high school, intersecondary is when you played outside. So intra-state is qualification, which means it's only in one state. For example, Ben and Jerry's ice cream. Yeah, baby, Ben and Jerry's ice cream. Originally only registered in Vermont. And what that meant was, in general, 80% of their revenues had to come out of Vermont. 80% of what they did had to be in Vermont. But here's the one that's most testable. 100% of the residents had to be Vermont residents for the first 6 months. So if you do a qualification, all the shareholders originally have to be state residents, and they cannot sell to non-residents for 6 months. They can sell to other state residents, but they can't sell to other non-resident. They can't sell to non-residents for 6 months. This next slide covers exempt securities and exempt transactions. And this is a real stickler for a lot of people. That this slide is probably an important slide to get. And this tricks more people up on exclusions and exemptions than I think almost anything else on this test. Okay. So first things first is we have what are called federally covered securities. If something is a federally covered security, then they do not register with the state. They immediately, regardless of size, become federally covered. So what are these? Anything to do with an investment company. So if you get and it's not going to go like, hey, Mike, I'm an investment company and don't say that I can be state registered. It's not going to go like that. On the test, it's going to say it's covered at a UIT or a FAC or an open-end fund or a closed-end fund. They're going to make it a little more subtle than just saying it's an investment company. And you have to know, oh, boom, that's federally covered. Okay. Reg D offerings. Reg D versus private placement on state, two different things. Reg D is a federally covered, and if you remember, 35 non-accredited investors or less cannot take any money. That is a private placement, like Silicon Valley boys doing their thing early on. They get tier one, tier two financing, whatever the hell that means. Okay. And they do a Reg D offering, which is federally covered, okay, exempt from state, and that's 35 non-accredited. But there's the state has what's known as a private placement, which is 10 retail investors or less. Don't forget, state does not recognize accredited. They go by retail. And anybody who's not an institution is retail coming in. And also exchange listed securities. Exchange listed securities are New York Stock Exchange, NASDAQ stocks. These are and any of their senior securities. So anything that's their preferred stock, their Class B, whatever it is, preferred L, whatever the heck they have, that's also exchange listed. So exchange listed stocks are listed stocks. And don't forget, when something's at NYSE or NASDAQ, we call that listed. When it's OTC, we call it unlisted. Investment company securities and Reg D. These are all federally covered securities. Next, we have exempt securities. These are exempt. They don't have to register with the state. Okay. And some of them don't have to register with anybody. So first we have government. What is that? Municipal bonds and government and treasuries. Bottom line, right? These do not have to register anywhere. And again, and one other thing to note here is there is exempt securities and exempt transactions. You could have an exempt security, but not an exempt transaction. I'll talk about that a little more, but these are exempt securities. Banks, except for what? Bank holding companies. Bank holding companies are not exempt. Bank holding companies are like Bank America, JP Morgan. They have multiple different arms to them. They're bigger, but your regular savings regional bank, that is going to be exempt. They're covered by the banking laws, not the security laws. Insurance, all insurance products and companies except variable, which is a lot of you have to take this test because of variables, right? Your company has you doing primarily insurance company stuff, except for the variables, which are covered by the state administrator or by FINRA or by SEC. So insurance companies except for variables. Common carrier. This is railroads, basically. I don't know how this wind up. This is some Gilded Age BS from 1875 of like, back the uh the crooked politicians of the 1870s somehow gave the railroad exempt, and it's now is carried on for 200 years past that. But common carriers in general are railroads. They are also utilities, but railroads is more that comes up. Federally covered, look right above. We talked about the federally covered already. No nonprofit, any nonprofit is exempt. Promissory notes, as long as they're uh, A, double A, or triple A in credit, and that they are $50,000 denominations. Employee plans are classified also as exempt. What is that? Employee retirement plans, federal benefits. Now, let's get to the next part, exempt transactions. And again, you can have an exempt security that's not exempt transaction. Example, which I saw on the 66, a treasury ETF. Securities exempt, ETF's not exempt, okay? Or a municipal bond fund. Municipals are exempt, bond funds are not exempt. Okay, so now let's go down to exempt transactions. This covers private placements, which are 10 retail investors or less on the state level, isolated non-issuer transaction, just two people who are non-issuers. I have some Apple stock and I want to give it to somebody that I know. That's an isolated non-issuer transaction. That's exempt transaction. All unsolicited. That's a big thing to remember, right? One of the things that happens is you can do exempt securities with retail if it's unsolicited. If they're telling you to do it, you got to do it. It is what it is, right? Unsolicited, unissued. Fiduciary transactions. So this is covers like executors, sheriffs, uh, trustees, basically everybody who has a fiduciary relationship with a customer. The only exception is custodians. Okay, so I like to say I grew up when kids weren't that important, right? Now kids are so important that even if you're a custodian, and that could be remember, any adult can open a custodial account. If you're a custodian and you make a mistake, even though it's covered by other people get umbrella coverage or safe harbor coverage, you don't get it because kids are very, very important now, not like they used to be. Um, bona fide loans, what does that mean? That's a margin loan or a mortgage loan. This is actually a loan. This is people getting money from each other. It's not really going to be securities related. Any issuer to underwriter, any like an APO or an IPO or anything where it's just the issuer and underwriter dealing with each other, exempt, because that's like two institutions dealing with each other. Institutional, we know. And pre-org, what is pre-org? Pre-org is you basically have agreed to give to participate on a venture down the road when it's there. But here's the main thing to remember between a little hack, pre-org and private. Pre-org certificates are no payments. You don't make any payments. Private placements, you usually made some kind of payment. Okay, now we're going to talk about offers and sales, what is and what is not. What is and what ain't. All right. So, and if you remember, we said what gives an administrator jurisdiction, an offer or sale in their state. That gives them jurisdiction. Again, doesn't mean they have to register, but it gives them jurisdiction. So what is it? An offer is any attempt to buy or sell a security, right? Any attempt to buy or sell a security for value. If if I made an offer and say it was an illegal offer, I did an exempt or I recommended an exempt security to a retail investor, and they said no, they didn't do the sale. So that's what the sale is. The contract or the actual disposition of the security, buying or selling, but they turned me down. Could I still get in trouble with the administrator? Absolutely. Regardless of whether or not the contract was sold, if you make an offer that's no bueno, you're going to have a problem. Okay. Now, bonus offer securities. Never in my life have I seen this, and I've seen a lot. Okay, but it's on this test. What is a bonus offer securities? I go in to buy a Ford truck, a F-150. And the guy selling it goes, "Hey, buy the truck and you get an extra 100 shares of Ford for free." Okay. Well, the administrator says they're not free. He said they're part of the price of they're part of the price of the truck. And that car dealer would have to be registered as a broker dealer to make that transaction. Okay. Or if I went into Best Buy and I went to buy a toaster and they go, "Yeah, by the way, take 25 shares of GE for buying this toaster." Well, that Best Buy would have to be a broker dealer because they have made an offer to me. And if I take the toaster, that's been a sale or for sale. Accessible stock, another thing that's like archaic and not around anymore, but I'll tell you what it is. So companies would offer a stock and say, put a $50 par value on it. Okay. So they put a $50 par value, but say you only got paid $30 now. Pay me now and I'll pay. Can I pay you Tuesday for a hamburger I eat in front of you? So the accessible stock is that you pay $30 and then 6 months down the line, you have to pay another 20 to get to par 50. The deal is if you try to give that as a gift to somebody, an accessible stock, that is considered an offer or sale because they have to pay that extra 20 down the line. So you're kind of pegging them or something. So an accessible stock is an offer or a sale as a gift. So you'd have to be a broker dealer to do that. Um, if it's non-accessible, which means it's already fully paid for, that's a gift. That's fine. Any offers of warrants, rights, derivatives, convertibles are all offers and sales. Okay, because they're going to convert into what do they all convert into? They all can convert into common stock. What is not an offer or sale? Any kind of bona fide pledge or loan. We talked about that earlier. A margin loan or a mortgage. Gift of non-accessible stock, Bob. And now the next one, the last one, stock dividends, which is also a good thing. Why would stock dividends not be considered an offer or sale? Because you wind up in the same spot you started. A stock dividend, if they give you more shares, less price, at the end of the day, you have the same amount of money. Same thing with corporate actions. If they're going to do a corporate action, if they broke up Amazon 1,000 shares of Amazon. They said, yeah, the 10 different companies Amazon is, you get 100 shares of each one. You actually still have the same value of Amazon at the end. Now, you're hoping it's going to do better. It probably will do better, but at the moment, it does not do better. Same thing with stock dividends. If you had 100 shares at $75, or if you had 100 shares of stock at 100, and a 25% stock dividend, now you have 125 at $75. No big deal, no difference. Nothing changed, so it is not considered an offer or sale. Okay, now we're going to talk a little about who has to register with who. Okay, federally covered advisors. So if are running, you and IA, first of all, there's three IAs: small, large, small, medium, and large. Small, I believe, is 20 million or less. Medium is 100 million or less, and then large is over 100. And one of the questions they'll ask is, do all large advisors have to register federally? And the answer is no, because between 100 and 110 million AUM, they don't have to register federally. They can say state. They have the option. They can go either way. Once they go over 110 million, then yes, federally covered advisors have to register. If an advisor is in 15 or more states, but below 90 or 50 or whatever it's going to be, in that case, then they have the option to register federally. 15 plus states, they can register federally. And as I said, once an IA goes over 110 million, that's it. They have to register. They have to register federally. Now, also, any federally covered advisor, we kind of hit this earlier, right? Which is investment companies, Reg D, or investment companies, Reg D, or a federally covered security have to register federally, have to register with the SEC. Now, what happens if you fall below 90 million? So, in other words, you're swimming with the big guys. Things didn't go so well. You get a couple of bad hits, and now you're down below 90 million, which is the magic number. 90 million and lower is now you've got to get deregistered and become a state IA again. Here's the way it works. First of all, they don't measure it till the end of the year, so it's the end of your fiscal year. And then once you hit, if you have this problem, you have 6 months to deregister or 180 days to deregister once you've fallen below that number. just to touch base a little on the previous slide, I did want to mention a couple of extra things in there. If you have there's an entity called a private fund advisor, which is a hedge fund or a family office. And the deal there is if you're running more than $150 million, you must become federally registered. Below that, it's not stated. It's a whole nother thing at EAR, which they're not going to ask you about. But a private fund advisor is unique that it's 150, more than 150 million they have to. Also, pension consultant, which comes under the 1092 rule of having to be registered. They do have to register as an investment advisor, but if they're over $200 million, they have the option to become federally covered or not. So pension consultants have that option. All right, next, we're going to talk about custody rules. So if you hold client funds for more than 3 days, you have custody. Okay. And that creates a situation that can create a situation where if you hold them and you don't have and you're not allowed to have custody, you're now violating USA law. Also, an agent, and this comes up, an agent cannot keep the money if they cannot hold the money themselves. Right. The old thing is like, I'm going to put the money in my blue suit upper pocket. Okay. That's where your money's going to be. No, that doesn't work. Okay. If you're an agent and you have clients' funds, you have to get that to the broker dealer. No matter how good your safe is in your house, you can't put it there. And I've seen questions asking about this. Agents cannot hold the funds of customers. That is not legal tender. Now, how does an IA get permission to have custody? First, they have to check to see that the state allows custody. That's number one. Then they do a disclosure on the Form ADV that they're going to be a firm that does custody. They don't have to straight out ask permission from the state. They just have to make sure it's allowed, put it on the ADV. Then they have to agree to a surprise audit by a third party, a certified firm. That's ADVE. That's the only ADV form that's not done by the IA. And they have to do quarterly statements must be sent to clients, which I never got because that's standard anyway. So quarterly statements have to be sent to clients. The only exception is if it's penny stocks and it has to be monthly. Now, remember we said IAs are net worth, BDs are net capital. So the numbers for IA's net worth is $35,000 for custody, $10,000 for discretion. What if I drop below that $10,000 number? So here's what happens. First things first is you have to let the administrator know by the end of the next business day that you went below the $10,000, and you have to have a written file in within 2 days of that. You have to file a written report of what's going on, but you have to let the administrator know by the next business day, close of the next business day. Now, if you're going to try to fix it financially, you can't just go to the number. So let's say you went down to 8,000 and you're going to try to get back into good standing again. You can't just put in 2,000. You have to do this $5,000 at a time, whatever that comes out to. So if I drop down to 8,000 on discretion, I got to put in 5 and make it 13. Let's say I drop down to 28 with custody. Well, I got to go to 38. I got to do 2 lots of 5,000 to get back into good stead. So it's lots of 5,000, and you have to let the administrator know within the end of the following business day, and then within 2 days you have to have had a written report telling them that you screwed up and you got a big problem. Houston, we have a problem. I got a big problem. Okay. Civil liabilities versus criminal liabilities. How do I know the difference? It's easy. Did you do it willingly or did you do it unknowingly? The in real world, uh, ignorance is not ignorance is not a defense. On Wall Street, it is. I honestly, I did 2 depositions in my life, both scary as F. Okay, but neither one of them were even my fault. I was doing it for other people, right? But I got called in, and my lawyer said to me, he said, if there's any way to get to I don't know, get there. If there's a little increment of something that you don't know, say I don't know. So I don't know is civil. I did it and I knew, that's criminal. So civil liabilities had the 3-year statute of limitations but once they find out there's no more than 2 years of post discovery to file the claim. So once they find out that you have an issue, then they got to get to you within 2 years or it's done. And one of the things that happens is if after a year or so that you haven't heard from them, if they don't send you a letter, then it kind of goes along. So if you're somebody who's ever had a problem after the first year, you're sitting there going like, please don't send me a letter, please don't send me a letter, please don't send me a letter. Because if it goes past 2 years post discovery, they can't do anything. So now, if you have a client that you made a mistake with, you let them buy an exempt stock or you did something stupid, you're allowed to do what's called a rights of rescission letter to the client to actually repurchase or resell at the original cost, including interest and legal fees, minus whatever income they had. And you send that letter making an offer. If they don't answer within 30 days, if they ghost you for 30 days, you're off the hook. You're okay. Client has 30 days to accept or reject the offer on a rights of rescission letter. All right, criminal penalties. Now you done it. Now you done it. You got a problem. So the criminal penalties at the state level, 553. Okay, and again, how do we know it's criminal? You willfully did it. You can't deny it. You can't deny that you did it. You did it. 553. So that's 5 years of statute of limitation, $5,000 maximum fine, 3-year jail sentence per charge. And keep your eyes open because sometimes they'll say 4 charges and you got to add it all up. Okay. So criminal penalties are knowingly applies when they willfully violate the law, and it's 553. The way that I remember it is if you can remember the jail sentence is 3, the rest is easy after that. Unless, of course, you're actually doing the time. By the way, I always say it doesn't seem even like they really convict white collar criminals anymore. I haven't seen anybody go to jail pretty much since Bernie Madoff, except for the crypto guy, right? I don't know. They don't go after people anymore, it seems like. So with that, we came to the end of the Series 63 slides. Um, I will do some other ones a little more in depth as we go along. But in general, if you have down what we went over and hopefully can expand a little more on each of those things, I think you're going to be okay on the 63. Um, I will also be adding those to when I start 65 and 66 info. Those are all the USA regulations. I wish you guys a ton of luck. Keep me up on how you do. And again, if you need any tutoring help, you can always go to Buttonwood Tutoring, buttonwoodtutor.com, and I will be there. Take care.